Welcome to Iron Financial, the only place dedicated to helping you forge a stronger portfolio and cut through all that market weakness. Today, we are putting Viper Energy under the microscope. In 2025, they literally spent billions of dollars completely remaking their company from the ground up. So we're here to figure out if they've actually built an impenetrable Permian fortress or just an over-leveraged house of cards. Okay, let's get into it.
Whoa, okay, analyst, I gotta jump in here. The sheer amount of activity is kind of making my head spin. You're talking acquisitions, divestitures, these drop-downs, it's a total whirlwind. And you know, whenever I see this much chaos in just 1 year, my first thought is always the same. Have they actually made the company stronger, more resilient, or have they just bolted on a bunch of shiny new parts, creating a complex mess with huge integration headaches and a whole new world of risk for investors? Because right now, just looking at it, it looks messy.
And that, right there, is the multi-billion-dollar question we are going to answer today. We are going to deconstruct this entire thing piece by painful piece. We're going to look at the blueprint they followed, we're going to stress test the financials to find any and all cracks, and we're going to inspect the payout plumbing to see if it can even hold pressure. By the time we're done here, you'll know for sure whether the new Viper Energy is sitting on a rock-solid foundation, one that's built to last, or if it's just a fragile structure that's going to get blown over by the first strong wind.
So let's start with the blueprint itself. Section 1, Viper's tectonic shift. And let's be clear, this was not a simple renovation. This was a complete teardown and rebuild. We're about to deconstruct the major deals that completely redefine this company in 2025.
You know, what's really incredible when you look at this slide is the speed, the sheer pace of it all. This wasn't some 5-year strategic plan they rolled out. No, this was a 12-month blitz. It all kicks off January 30th. Bam! They announce a huge asset transfer from their parent company Diamondback, plus another deal. By May 1st, that's already done. But they don't even stop to breathe. By August, they've already closed the monster acquisition of Sitio royalties. Then, come November, they pivot again, selling off all their non-core assets to really sharpen their focus. And that deal is closed just a couple of months later. This timeline just screams relentless, aggressive execution.
Okay, so let's break that down into simple terms because all the corporate speak can get confusing. Step 1, you've got this drop-down. All that means is Viper bought a huge chunk of assets directly from its parent, Diamondback. Think of it as an internal transfer, but a really, really big one. Step 2, they basically swallow a major competitor, Sitio, in a massive all-stock deal. This isn't just buying a few oil wells, this is a major consolidation play. And then step 3, they shed weight, selling off everything that wasn't located in the Permian Basin. Now, my concern here is the execution risk. Juggling just one of these deals is incredibly difficult. Juggling all 3 at the same time? That's a high-wire act, and I want to know if they pulled it off without dropping anything.
And to really understand the scale of that high-wire act, you have to follow the money. The Sitio deal alone was a $4 billion transaction. Let that sink in. $4 billion. And, this is absolutely crucial, it was an all-equity deal. That means they pulled off this massive move without crippling their balance sheet with a mountain of new debt. No new interest payments to worry about. Then you add in the billion-dollar dropdown from their parent and another $211 million on top of that. On the flip side, they brought in $670 million in cash from selling off assets. All told, we're talking about almost $6 billion in deals changing hands. These aren't just minor tweaks to the business, these are company-defining, foundational shifts.
So the whole point, the strategy behind all this construction was crystal clear. They wanted to forge a pure-play Permian powerhouse, period. Anything that wasn't a core, high-quality piece of land in the Permian Basin was considered a distraction. So out it went. Anything that deepened their grip on the Permian, they brought in. The goal was to create this super-focused, streamlined machine that owned the best assets in the most productive oil basin in North America. When you're building a fortress, you only use the strongest materials you can find.
Okay. The blueprint is definitely ambitious. I get it. Go all in on the Permian. But, a blueprint is just a piece of paper. Now we have to actually test the load-bearing financials. And when I look at the headlines from their latest earnings reports, I see some pretty serious red flags. I'm talking about massive losses. So, analyst, let's get into the guts of these numbers. Is this new structure financially sound, or are we about to find some major cracks in the foundation?
All right, let's just rip the Band-Aid off and confront that headline number. Q4 2025, Viper reports a consolidated net loss of $246 million. Look, on the surface, that's a jarring number. For a company that just spent billions transforming itself, a $250 million loss looks like a complete and utter disaster. This is the kind of number that sends retail investors running for the hills. It looks like a giant crack right down the middle of their new foundation. But this is exactly why we dig deeper. Headlines are for amateurs. The entire loss, and then some, is because of something called a non-cash impairment charge. You have to understand this, it's an accounting rule, it's not a business reality. Because of how the deal was structured, when Viper acquired those assets, they had to put them on their books at the old historical value, not the price they actually paid. This forced them to take a huge, one-time, non-cash write-down of over $400 million. Let me be perfectly clear. This is not a real-world loss. No cash left the company. It's an accounting phantom, a ghost in the machine that tells you absolutely nothing about the health of the business or how much cash it's generating. It's noise, and we ignore noise.
And this slide right here tells the real story perfectly. Over on the left, you see that scary official GAAP loss of negative $246 million. That's the accounting fiction. But when you strip out that non-cash nonsense, you get an adjusted net income of positive $121 million. That's getting closer to the truth. But the real number, the one that truly matters for a company like this, the real load-bearing beam, is cash available for distribution. And in Q4, that number was a rock-solid $145 million. So while the accountants were forced to book a huge loss on paper, the company was actually a cash-generating machine, throwing off almost $150 million in a single quarter. That's the structural truth.
Okay, I see your point on the cash flow. The engine is definitely running. But look at the output from that engine. This table is showing absolutely explosive growth. Average oil production is up 122% year over year. Total production is up 139%. That is a jaw-dropping jump in output. So now the question becomes, is this for real? Is it sustainable? Is this genuine long-term growth, or is it just a temporary sugar high from slapping CDO's production onto their books? An engine running that hot can burn out pretty quick. We need to know if this is durable or just a one-time surge.
That is exactly the right question to be asking, and the answer is found in what they're doing with all that cash flow. Which brings us to Section 3, the capital return machine. Look, a strong structure isn't just about generating cash. It's about getting that cash to its owners efficiently. So we need to take a close look at this payout pipeline and figure out if it's built to last or if it's a leaky pipe that's going to burst under pressure.
What's really interesting here is how balanced their approach is. In just Q4 alone, they returned $131 million to shareholders. And it wasn't just a simple dividend check. Look at the breakdown. You've got a $65 million base dividend. That's the steady, predictable foundation of their return. Then, on top of that, they paid a $23 million variable dividend. That's the kicker, the bonus you get in good times. And crucially, they spent another $43 million buying back their own stock. This shows a smart, multi-pronged strategy. It's a sign of a really disciplined approach to capital allocation.
And it's clearly not just a one-time thing. Management is doubling down hard. They just increased their share buyback authorization by a full $1 billion. $1 billion! Now that's a massive vote of confidence from the people who know the company best. But it also raises a question for me. Is that really the absolute best use of capital? Or is this just an attempt to prop up the stock price after a year of M&A chaos that might have scared the market a little? I mean, $1 billion is a ton of firepower to use on defense instead of offense. We need to know the motive.
And they're telling you exactly why they feel confident enough to do it. Just look at the CEO's own words. Kais von Hoff says, "We enter 2026 with a fortress balance sheet, and that they are well-positioned to increase our return of capital upwards of 100%. He doesn't just say the balance sheet is good or solid. He uses the word fortress, and he's telegraphing a very clear plan to potentially return every single dollar of available cash to shareholders. That's a public commitment. He's putting his credibility on the line, and it signals that they believe this new structure isn't just stable, it's exceptionally strong and ready to pay out."
But look, a fortress isn't just about what you've already built. It's about having a plan to maintain and strengthen it going forward. And that brings us to Section 4, forging the 2026 blueprint. The past is important, sure, but for investors, the future is what really matters. So let's dig into their forward guidance and see what the plan is for the next year.
The 2026 plan really rests on 4 key pillars. First, they're hiking the base dividend by 15%. That's a direct, tangible increase in shareholder returns, and it's a huge sign of confidence in future cash flow. Second, they're setting a clear, disciplined target for their long-term debt. They're not going to let leverage get out of hand. Third, they're telling you exactly how they're going to use the cash from the asset sale to pay down debt immediately. And fourth, they're guiding for continued strong oil production, proving that the growth we saw last year wasn't some kind of fluke. This is a clear, powerful blueprint. It shows real discipline. And here's the thing, they didn't waste a single second putting that plan into action. This is the crucial follow-through. The asset sale closed on February 9th, and they immediately took that cash, all $617 million of it, and used it to completely wipe out a $500 million term loan and pay off their entire credit card balance. This isn't just a promise to deleverage, this is a demonstration. They are actively reinforcing their balance sheet, which cuts down their interest payments and gives them way more financial flexibility. It's a very strong move, and I'll admit, it does answer some of my concerns about their financial integrity.
All right, we've deconstructed the blueprint, we've stress-tested the financials, we've inspected the capital return pipeline, and we've reviewed the plans for the future. It is time to put all the pieces back together and deliver the final verdict. Section 5. Is the new Viper Energy an opportunity, or is it a trap?
So let's lay it all out. The bull case versus the bear case. The argument for the bulls is pretty compelling. You've got a laser-focused, pure-play Permian company. You have what they call a fortress balance sheet, which is now even stronger. You have proven explosive growth in production, and you have a management team that is aggressively returning capital to shareholders. That is a powerful combo. The bear case, well, it centers on the risks. Integrating a huge deal like CDO is always complex, though most of that heavy lifting is done. And of course, their future is tied directly to volatile commodity prices. Plus, their growth depends heavily on their parent company, Diamondback, continuing to drill.
So, the iron financial verdict is this. The heavy lifting is done. The year of chaotic transformation is over. And what's emerged from all that dust is not a house of cards. It's a more focused, more powerful, cash-generating machine with a newly fortified balance sheet. They navigated all that complexity and actually came out stronger on the other side. Our analysis shows the structure is fundamentally sound. They've forged a compelling opportunity here.
But let me add the crucial caveat. The risk here is not a structural failure. We agree, the chassis is strong, the engine is powerful. The risk is external. This fortress they've built is located in a very volatile neighborhood called the global energy market. The engine is built for high performance for sure, but it still runs on oil and gas prices. Any investor has to understand that even the strongest structure in this entire sector is still subject to the massive, unpredictable storms of commodity cycles. The company is solid, but the industry will always be cyclical.
Exactly. And that leaves you with the final question. Viper has successfully forged a brand new, more powerful identity. The company itself is structurally sound, so you just have to ask yourself, is my portfolio built to handle the kind of commodity risk that comes with owning any energy stock? Or am I playing it so safe that I'm willing to miss out on what looks to be a significant structural opportunity? That's the decision you have to forge for yourself.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.